The total crypto market cap has risen by almost 10% in the first 10 days of 2023. Bitcoin has reclaimed 17,000. We're seeing some nice movement heading towards a potential huge reversal pattern with CPI data looming in 2 days. Loads to cover off. Money is starting to flow back into crypto. In this video, we're going to analyze exactly the patterns, exactly the key levels I'm looking out for here on Bitcoin and the wider crypto markets, plus a deep dive into what we're expecting for CPI on Wednesday and what impact that could have on the markets. As you can see, guys, this is the total crypto market cap, and we are now sitting at 809 billion. When you look at where we were on the 30th of December, we had a reading of 745 billion. A huge move here to the upside in just 10 days, and you're seeing now that euphoria is starting to return back to the markets. If we take a look here at the Bitcoin price, we have seen a good set of days here since the new year flipped, and we've seen only just 2 small red days here. Apart from that, nice big moves to the upside. I'm going to share with you the exact pattern I'm monitoring, which is this double bottom formation, okay? This double bottom formation with a higher low, on the right hand side versus this one is a very nice pattern with a neckline at 17,800. I'm going to share with you my exact price target, but first, we need to understand what are markets being driven by. And the first thing we need to understand is last year was heavily CPI focused. Now, CPI is still going to be in focus, but it's taking a backseat to the jobs figure. We covered off the jobs figure on Friday, which showed more non-farm payrolls than we expected. So then why are markets rallying? Well, markets decided to focus on the fact that wages, the month-on-month and year-on-year wages, had declined more than expected. Remember, you get this wage price spiral? That is what the Fed is now worried about. In other words, the Fed is almost saying, you know what? We've done our job on inflation. I've seen CPI come down. I'm pretty confident about that. Now, I'm going to come on to why that's a dangerous strategy shortly when we talk about CPI. But for now, you can see that markets are using the bellwether as the jobs figure. That jobs figure, the non-farm payroll, the private one, which comes a couple of days before it every month, that's the one we got to focus on, because that's what's going to drive the hawkish moves and the dovish moves, or the bullish moves and the bearish moves in the markets to start off this year. That's what we've seen. This is why we've managed to see some greenness in the markets, is because of that non-farm payrolls. But it's very important we do not ignore CPI. It's very important that we're able to focus on the CPI as well. And in that vein, what are we looking for on CPI? Well, let's start off with the headline month-over-month figure. Markets are expecting, and this is going to shock you guys, 0%. Yes, they're expecting 0% inflation month on month, which is huge. In other words, a run rate of no inflation year on year. That's lower than what the Fed wants, right? The Fed is happy with a 2% run rate annually, which is about 0.16 or round it up to 0.2 per month. So they're expecting 0, which is huge. Then if we want to take a look at, we can take a look at the headline inflation rate. And that headline inflation rate is expected to come in at 6.5. So again, let's take a look at what we had. We had 8.2, dropped down to 7.7, dropped down to 7.1. Now they're expecting a drop down to 6.5. That's a big drop, guys. That's 0.6 drop there. And again, that's showing us that the Fed really thinks this headline inflation is going to collapse quite quickly, and markets are going along with that thought as well. So we're expecting that reading on Wednesday. Then if we take a look at the core inflation rate, which obviously excludes food and energy, that is expected to come in at 5.7. Again, you had 6.6, 6.3, 6. That's expected to come in at 5.7. So the same run rate of knocking off 0.3 again in this latest month's reading. So in other words, markets are feeling confident that this can happen. And we've got to be careful, because this can easily surprise us. Okay, I want to show you what people are not talking about right now. And this is a hidden thing you guys have to be aware about. Look at this. We've been monitoring this for a very long time. And if you look here, the next FOMC meeting is set for the 1st of February. Okay, so we're about 3 weeks away from that. Now, 83% of the market are pricing in a 25 basis point increase in the interest rates. 16.6%, and this is notched up, guys. This was basically 0, then it was 5%, 10%, now it's 16% of the market is expecting a pause. This is very, very interesting to see. In other words, markets are starting to become very, very dovish. They think that the Fed are going to go for a pause. Now, this is a double-edged sword. It's good because it means we get the rally now. Markets are going to price in a pause for the next meeting. But what happens if we don't get a pause? What if we get 25 basis points? What if you get what I'm thinking, which is maybe even seeing 50 basis points? right? Then we're going to see redness come in the market after this FOMC meeting. So we've got to be very, very careful from a fundamental point of view. Let's take a look at the fear and greed index. It's sitting at 25. We're still in extreme fear, but I tell you what, on the ground level, you are feeling something different. You are seeing money come back in. I'm going to prove that right now. Let's take a look at Bitcoin dominance. Look at what Bitcoin dominance has done. We wanted to this. We said we expect it to come and revisit back down to these levels. And look at that. We predicted it perfectly. We predicted this, okay? And this, what is this? This is an altcoin rally. Anytime the dominance is falling, altcoins are doing better than Bitcoin. But why would altcoins do better than Bitcoin? By definition, altcoins do better than Bitcoin when risk is rotating back on, which is exactly what we're seeing in traditional markets. After the non-farm payrolls, after seeing that CPI is starting to improve, markets are starting to feel a little bit confident to start allocating the funds. Funds which may have been in bonds or maybe sat in cash. Maybe they're going, you know what? We could be rotating soon. The Fed could be pausing any month now and they could start to rotate. And if our money's not allocated, we're going to miss out. So risk starts to rotate back on. And that is what we're seeing now. We're starting to see altcoins really move. Let's take a look here. If you look today, Bitcoin's moving 0.5%. But therefore, look at Ethereum, 2.2%. Look at Solana, 13% today. Phantom, 2%. Dogecoin, 5%. Cosmos Atom, 5.6%, right? Avalanche moving at 2% today. Everything is moving at a multiple of the rate that Bitcoin is moving. Chainlink, 2.5%. Polkadot, 3%. Koti, 6%. You're starting to see altcoins move, which is reminding us that people are trying to allocate. They don't want to miss the next run up, and they're starting to feel that it could be sooner than we think. Okay, so you've got room there for more fall to the downside here on Bitcoin dominance, which means more of a altcoin momentum. So now let's look at this double bottom pattern, which we're starting to play out here on Bitcoin. So you can see this is forming. You can see we're on the upwards wedge. And obviously I'm just theorizing that we could be forming this pattern. The neckline is along here at 17,800. Now, why is that an important level? This is not a made up level. I'm going to show you here. Let's go back to my other chart. And if I zoom out, what was this level we spoke about this whole time? 17,600, 17,700 level. That is your June low. When we fell from the Terra Luna collapse last year, that is where we built support and then we ran up to 25. Okay? We only broke it after Sam Bankman-Fried and FTX. So what I'm saying is we've then tried to go back to that level and look where we got rejected. We got rejected at those same levels, 17,800. See the candle body closes? Let me just zoom in for you guys. There, see those candle body closes? It's around that 17,800 mark. That is why it's very important, coming back to our pattern here, that we get to this neckline and then we see what happens. Okay, it's very important that you don't over-egg this because we can get rejected from this level. We got rejected from it before and we can get rejected again. But if we are able to, the textbook pattern here is for us to break out, retest, and then get a nice big move to the upside. Again, if technical analysis is new to you, if you're not quite understanding all these patterns and you want to get caught up, ijaz.uk/TA. I'm the only person that's made my whole TA course available for free, guys. Not charging you thousands of dollars. It's there for free. Won't be free forever. ijaz.uk/TA. Learn all these patterns, all the indicators I'm using. You're going to be brought up to speed very, very quickly. Okay, so that's the thing I'm monitoring here is can we get that move up towards 17,800 and then break above it? But it's not just that. There are so many more exciting things happening from a technical perspective. And anybody who's watched my content knows I do not just get excited straight off the cuff like that, right? But from a technical perspective, look at the daily chart here. The candle we are forming today is 10 hours away from closing above its daily EMA ribbon. Good sign, right? Now, again, we're not going to get carried away because we've done that before. Remember this candle here? At one point during this day, which is the FOMC meeting on the 14th of December, right? Just the last meeting we had a couple of weeks ago, we covered it. And as Jerome Powell speaking, we saw this nice rally going through, and this looked like an amazing candle, right? Flipping our daily EMA ribbon bullish, but then what happened? We got faked out and we got thrown straight back down to the downside. But it's one indicator, and you want to get confluence. You want many indicators to show you the same thing. So let's take another look at another indicator. Let's take a look at our VPVR. We are now above the point of control. We've broken through the key level of struggle at that 17,000 level. That is why that level is so important. We were here for a very long time just hovering around, but we need more volume. Volume is not looking great, okay? This is not looking great for me. I'd rather see much more stronger volume, but it's okay. Hopefully that volume comes in closer to when we're trying to break through here. I want to see some nice big volume candlesticks as we try to break this neckline. That is going to be important. So the VPVR is on our side. That's good. Let's take a look at another indicator. What else could we look at? You guys know we can look at the Bollinger Band. Again, if it don't make sense, ijaz.uk/TA. We are breaking to the upside of our Bollinger Band. Again, we have done it previously and we got thrown to the backside, so take it with caution. but it's good. We are breaking to the upside. We are getting some bullish intent here from the market. So when you tie all this together, we are getting a very nice move here on Bitcoin, leading and timing perfectly with a critical CPI reading on Wednesday. And all of this together could set the scene for CPI either making or breaking Bitcoin. And what is my price target? Where do I think Bitcoin can go from here? Let me show you. So let's bring out my drawings. And what we can see here is the following. Let's take our measured move. And what you want to do is you want to take it from the top here down to the lowest point. Again, if any of this don't make sense, you guys know where to look. Let's take it to the point of breakout. Let's say we break out in a couple of days. Let's say around here. Okay, and that will bring you up to 20,000 on Bitcoin. And then we've got the next leg of our work, right? We know there's a bunch of resistance coming from here, and there's other levels we need to work for. But let's reclaim this 17,800 level. Let's work our way to 20. And that would be a beautiful trade, which you could take if we get the volume breakout. Of course, not financial advice. Now, a lot of people are saying, oh, is this a viable move? Well, of course, if you look at where we're at right now to the neckline, that is only a 3.7% day. Bitcoin can do that. If you've been around Bitcoin for a while, you know it can easily have days like that, particularly if there's a macro catalyst. You also take a look at this day here. This day here was a 3.3% day. Look at the next day. You had a big day to the upside, but it just gave it all back up later on. So those types of impulsive moves on Bitcoin are definitely possible. You've had a down day there of 4.4%. So there's no reason you can't have a nice big 3% day or do 3 to 4% over 2 days here on Bitcoin to get you to that neckline and get a nice volume breakout. So that's what I'm looking out for. But you cannot rule out the fact that you can get rejected from here. So be very, very cautious. Do not be greedy in the run-up. Wait for it. Wait for confirmation. Wait for that. And then enter your position. Okay? It's very important that you play that breakout carefully. And if you're not experienced at doing that, make sure you watch the TA course and you'll see exactly how to do that. Let's also take a look at the dollar index. We know that the dollar index tends to show where the market is going because it's inversely related to crypto, and we're seeing a really good downward move here. I'm just going to show you, I mean, we even had our arrows exactly there showing what we're expecting. Let's bring out the EMA ribbon, and we got the exact perfect move, which is what we wanted. The dollar index did exactly as we predicted. It ran into the EMA ribbon, but thankfully it got rejected by the EMA ribbon, and that is good, right? We want lower highs and lower lows. That's what the downtrend is. And again, if we flip that back up to the weekly, that just means we continue to show strength on the weekly, pushing this dollar index down. So that's all looking good from this perspective as well. Remember, this chart going down represents risk turning on, okay? The more this is going down, the more risk is turning on, the better for crypto, the better for altcoins. Let's look at traditional markets here in the pre-market. We are getting a bit of green. NASDAQ 0.6, 0.47 on the S&P, and Dow Jones 0.3. They're still building. They're trying to build on the rally from Friday with the non-farm payrolls. Again, the non-farm payrolls themselves weren't great, but they're focusing on that wage element. If wages can start to come down, people will spend less, and you will avoid this wage price spiral. If wages keep going up, people spend more, wages go up even more because people can't afford stuff, so they ask for pay increases, and then people spend more, okay? So that's where we're at in the market. Definitely one of the more exciting days we've had in a long time, but more important than just the day, an exciting set of circumstance. Now, does this mean we've completely resolved every single issue? Absolutely not, right? We've not completely solved the issue. Inflation is still at 7%. Russia and Ukraine still have tensions. There are still things going on in the world. But we are starting to see green shoots. We are starting to see a route, and that's all markets want. Markets want to be able to see the path to the Fed pausing. If they can see the path towards the Fed pausing, which you've already seen that 16% of the market is pricing in, they will start to allocate their capital. And if you're not ready to allocate as well, you're going to miss out, and you're going to be buying at 10, 15, 20% higher prices. And that's the risk and the balance you have to make as an investor. I hope you guys enjoyed the video. If you appreciate this type of content, make sure you smash all the likes. Don't forget to subscribe. Check out this video here on how to navigate a recession in crypto, and I'll see you in the next one.